Welcome to the TrustedBridge Capital monthly video series entitled Know What You Own. I'm your host, Eric Jefferson, and for this month, May 2024, we're going to focus on long-short equity investing. Now, before we get started, we have a few quick words from our legal team. With that, we can go ahead and begin. And as we do, I want to start by offering some context. When you think about long-short equity investing, this was a strategy first employed by the first ever hedge fund launched back in 1949 by a gentleman, Alfred Winslow Jones. The strategy has been evolved over the past half century or so and has incorporated many of the top hedge funds and portfolio managers today, the likes of George Soros, Stephen A. Cohen, Bill Ackman, David Einhorn, arguably four of the largest names in that space today. Now we think, what is long-short equity investing? Well, as you can see in the objective there, the goal is to generate returns while minimizing direct market exposure. So long-term, we think the S&P 500 tends to be up 2.2 out of every 3 years. However, that 1 year it is down historically can be down very sharply. Obviously, that volatility can be painful, particularly for clients in retirement that are drawing down those assets. So the ultimate goal with long-short equity, generate those market-like returns, but do so in a way that's going to offer a smoother, more consistent period over the long term. How that's accomplished, generally investors will take two positions. The first, a long position where they will buy stocks that they believe are undervalued and therefore will appreciate in value. Conversely, they will establish short positions or sell stocks they believe are overvalued, with the thinking that the market will then come to realize that trade lower, and therefore managers can generate a process by closing out those short positions at now lower prices. So here we have a hypothetical example where a long-short manager, instead of investing in the market, will say, I want to own 100% of these high-quality stocks that have strong balance sheets, that have very attractive fundamentals. And conversely, I want to go short, or I want to sell the bottom quintile, the worst rated companies for 30% of my portfolio. I now in this scenario have 0.7 direct exposure to the market by 100% long position and a 30% short position. My net exposure to an overall move in the market much lower at 0.7, as opposed to simply investing 100% in high quality names. Now, why would you want to do that? Well, to answer that question, I want to start by looking at the actual data. Now, up on the screen here, we have the S&P Toronto Stock Exchange Composite. This is a collection of some of the largest Canadian companies. The reason we're focusing on the TSX, this data goes back much further than in the US. We also have in the middle of the screen companies held within that index that screen the highest for quality. Quality is defined as those attractive fundamental features, strong balance sheets, steady cash flow, etc. And then in the far right-hand column, we have the index that captures those companies with the lowest quality scores. Now, interestingly enough, going back to 2017, as we look at the data, the average return for all three of those indices roughly in line. The composite up 8.2 over that period, the lowest quintile up 8%, off, again, 0.2% over the course of a 7-year period. However, as we look within each year, particularly those more volatile periods, we do start to see a very wide-scale dispersion between the higher quality names and those that are lower quality. For example, I want to highlight 2022. That was a year where the overall composite index down 5.8%, but you saw very large dispersion. The higher quality companies a negative by just 0.5%, down 0.05, while the lower quality companies down over down double digits, over 11%. So where this all comes together, we're hopefully going to go through on this last slide here. If we think back to 2022, what happened that year? Well, the Federal Reserve and central banks globally very aggressively began raising interest rates. That, as we know, long term has a very inverse correlation with stock prices. So in our tactical portfolios, we had been positioned fairly conservatively in anticipation of this. And as we think about ultimately the overall risk return profile, this is where we think long short equity strategy makes a lot of sense, given you have the ability to profit off higher quality names, but also reduce your overall exposure by having a negative return to those lower quality companies. So let's go through and look at the data. If we were to go back 2.5 years to January 1st of 2022, you can see the average for the composite index, the first column there, up 3.9%. In that time period, we had high quality stocks up 8%, almost twice the overall index. That time period, we had those lower quality names virtually flat. Now, very easy to simply look at this graph and say, well, if I had a long short equity strategy up 7.7, that's certainly better than the broad market. Why though wouldn't I simply just invest in the high quality stocks that did a slightly better return at 8? And the answer there is we look at that far column. Each calendar year, you can see the long short strategy was positive. So what we talked about earlier, the goal of this is to generate market-like returns, but do so giving investors a smoother overall experience. This is especially important for clients that are in retirement or drawing down those portfolios. Obviously, if you sell a stock where it is meaningfully depreciated, you're in essence locking in those losses, not giving it a chance to potentially gain with a long or recover. With a long short equity strategy, this designed to smooth some of those losses, offer some more protection on the downside. Again, no expectation to fully keep up one-to-one in up markets, but where we have a overall macro environment that likely is going to be more volatile, that likely is not going to offer substantial 25-30% gains year after year after year. In that environment, we think a strategy that offers more consistent returns to investors, particularly while preventing and limiting those painful drawdowns, one that likely makes sense for an overall asset allocation standpoint. Well, that is all for today. As always, I hope you found that valuable, and by all means, happy to answer any questions. Please feel free to reach out to myself directly. Thank you.